If you are not getting educated about the current economic conditions as they relate to housing, whether you're in title, you're in mortgage, you're an attorney, you're an accountant, or obviously a real estate professional, you are doing yourself, your business, and your client base a disservice. This is the Knowledge Brokers Podcast. I'm Tom Toole. Byron Lazine's back from his sabbatical in Arizona at the Broke Agent Wedding. Grateful for you to be here, my man. And
grateful to be here.
After last week's show with Lisa, literally, the shit hit the fan. Silicon Valley Bank, it fails. Signature Bank over the weekend fails. And people start having these flashbacks to 2008 for obvious reasons because of banking failures, although I'm clear this is very different, and the market has interpreted this differently. Byron, tell us your thoughts, man.
This is what happens when we bring Lisa Chinati into Knowledge Brokers Podcast. 2 straight weeks, the three of us did a show, then you guys did last week's show together, and everything falls apart. Now, Lisa, in her defense, I screwed up I'm going to take blame for her not being here today because I know so many of you. Hit the thumbs up if you're missing Lisa. Lisa will be a mainstay here, just not today. A little Google Calendar, lack of it being on her calendar. She was double booked. But I'll take the blame for that so Lisa doesn't shred me next week when she comes back on here. So, yeah, it all hit the fan, Tom. The last 7 days have been wildly different than just dealing with inflation for when we look at these banks. In the past 5 days, or the past 7 days rather, we've seen 5 banks either fail or have to get injected with serious liquidity. You've got Silvergate, SVB, and Signature all failed. Just today, SVB filed Chapter 11 bankruptcy. And then you had First Republic and Credit Suisse both need to get injected with billions of dollars. First Republic, 11 banks announced, U.S. banks announced that they're going to inject $30 billion to instill confidence in the U.S. banking system. And then Credit Suisse got $52 billion from the Swiss Federal Bank. Okay, so banking right now is on really shaky grounds. That's what happens when you shut the economy down in 2020, tell people they're not allowed to work, print a whole bunch of money, just dump money into the system. And then in 2022, when you realize that there's inflation, you slam on the brakes instead of doing it maybe 6 months earlier when you saw signals of inflation, or instead of maybe stopping and not doing that last $2 trillion after the pandemic was already over. No, you kept the money print machine going. Now you had to just completely slam on the brakes, and now we're paying the price, right? We went a little too far. Jerome Powell went maybe a lot too far on the money printing machine, and we're going to pay a price. And the banks are paying a price right now because they've got all these assets that they accumulated during these times, which shouldn't be toxic assets. But if people are coming and asking for their deposits, they have to sell these assets off, which are longer term, 10-year assets or what have you, and they become toxic assets on the balance sheet when you have to sell them at a loss, and they're getting into problems.
So I've got a source. We're going to leave him as anonymous right now, and it's a he. And he works at one of the largest banks in the U.S., a regional bank based out of the Midwest. And I asked him, "Hey, what do you think about this? This is Sunday night, and this analysis to me, I'm going to read it verbatim."
So, to be clear, though, was this Sunday night after the Fed said they were going to save SVB depositors or before?
Let me give you the timestamp. It was at 8:32 p.m. on Sunday night, so it was. I think it was after. It was just after, and he'd been working all weekend dealing with this, and he's very high up there. He works directly with the CEO of this particular organization. So here's his take on this. I found this very interesting. The entire banking industry overinvested all of the pandemic liquidity from 2020 and 2021, and now all have larger negative marks, which impact capital levels. SVB got proportionally more liquidity and therefore invested proportionally more in bonds, so their negative mark was greater and almost completely eroded capital. But there are others. I just don't know who. I'm beginning to believe that the Fed is now forced to stop raising rates. We'll unpack that in a little bit. Treasury yields will fall, and stocks will have a choppy descent for the next few weeks until we gauge the extent of the fallout. But who's to blame? The final $1.9 trillion spending bill was the source of most of our current economic problems. too much liquidity was the singular source of inflation, the reduced workforce because people were paid to stay home, and now this. Washington will point fingers, but this is 100% a fiscal policy blunder. That's pretty well said. I mean, I think that sums it up pretty well. And what I like about this is someone that's dealing with this, right? They're at a regional bank. We had another source you and I both know. Don't want to give that up either. They work at even larger banks than this. They're worried about these small regional banks, right? And then all of a sudden, Signature failed Sunday night, and these banks had risky balance sheets. I mean, when your prime assets that you're investing in are crypto, VCs for startups, which have as high of a failure rate, maybe higher than real estate agents, and bonds that
is higher,
and bonds that are sensitive to interest rate hikes, thanks to the Fed, because we've had a ton of them. You're kind of set up to fail, and that's the disappointing part about this. Is I'm clear this could have been avoided had the policymakers been a little more diligent about injecting too much capital into the system. I think that's the fundamental issue.
The last $2 trillion that was printed, or 1.9 trillion for exact numbers, was completely unnecessary. And a lot of that money hasn't even been spent. So it's sitting there, right? This was supposed to be infrastructure. How many people in the comments have seen, a real significant, advancement in their infrastructure in their community? That wasn't for infrastructure. That was a really silly $2 trillion that we printed.
Mm-hmm.
So this overinvestment is right. And then, like, as SVB is concerned, they really advocated for this Trump era change to the way that they were regulated. They're like, hey, we're not one of these big banks, so don't treat us like one. And then all of a sudden they fail, their management fails, and they are treated like a big bank. So they got it both ways. They got to go, that CEO, if you look at the timeline the last couple of years, just pulling money out of the stock.
Yeah, I saw that.
$3.5 million just a couple of weeks ago. They got this deregulation, got to go wild for a couple of years, lined their pockets, and then the federal government came in anyway and insured depositors. And listen, I think I believe that those depositors should have been insured, maybe except for Roku, because they had $500 million in one account, and Roku's not a small business. Their CFO. But if you insure one, you got to insure also. Listen, generally speaking, I think all the depositors should have been insured, but we're really setting up, a precedent here now. I mean, what does this mean as more banks continue to have issues? And that's what we've seen all week, that more banks are going to continue to have issues.
Well, and again, I mean, there's been such an injection of capital into the system. And, but I think the source that I had, I think you hit it on, people were getting paid to stay home, right? So then you got all this disposable income. I mean, you look at just what's happened with crypto, right? I mean, a year ago, 2 years ago, people were like, I got to buy crypto. And long term, it could be a good investment. My thought was, if you buy crypto and you don't know what you're doing, you're going to get your ass handed to you. And that's exactly what happened here. So they had a risky balance sheet. So did Signature Bank. And this is called a free market. I mean, when you see people invest in things that are risky, there's a chance you'll lose your money. That's just how it goes. And so knowing all of that, I mean, I don't think this is a bad thing long term for the economy, because if you let just people have it both ways, like you said, it doesn't work that way. It's got to be one or the other. The policy blunder's an issue. What I want to talk about is how the housing market reacted, because this, to me, is a positive for some of the consumers that believe in investing in tangible assets like real estate. You get the house, you've got something that's real. It's not like metaverse real estate. It's actual real estate. And we saw rates have danced around a lot. Probably one of the most volatile weeks. You and I have been doing this almost 40 years combined, right? One of the most volatile weeks with rates. And it is a day-by-day trend. And the value here for the consumer that has a more conservative approach with their money, fiscally conservative is what we're talking about here, is that this may help you long term. This will impact the Fed meeting coming up. I think they're and if you look at the CME Group's Market Watch tool, it almost flipped, where a lot of people just 2 weeks ago we were talking about 50 basis points. 50 basis point increase at the next meeting. That's become much less likely, and it looks like it's either going to be a flat change or a 25 basis point increase. So the Fed is taking note, and I'm clear they're going to have to slow their strategy down here. Because last Friday we're talking, and it was right after Powell came out and said, we're going to be even more aggressive with rate increases. And I don't know that you can have that same policy given the fallout for the actual banking institutions and the consumers that were affected by this.
Yeah, to your point, the market right now is now pricing in a 25 basis point hike, not the 50 basis point hike that I believe a couple weeks ago on the pod we said was like a
73% or something. Yeah.
Yeah, something like that percent chance that it was going to be a 50 basis point hike. That seems to be off the table next week. Next week, when we do our Friday pod, we'll obviously be able to see what the Fed did. I would be championing a flat. Don't do anything. Double Robert Parrish there. and don't do an increase, right? Because there's too much pressure on the banks. I'm not only saying that because I know that, pausing interest rates would bode well for the 30-year fix and ultimately for the spring housing market. I'm saying it because if we have a cascading effect of bank failures across the country, we're going to have bigger problems than the 30-year fixed on our hands. Okay, all the buyers and sellers and investors that you're consulting right now are going to have much bigger issues if 10 banks fail over the next 14 days than what the 30-year fixed is. And we're going to be having different discussions with people. Okay. So, I think they should pause and just kind of sit back. We know that we've seen some signs of disinflation. So let's take a longer look, especially in the light of what's happened in the last 7 days. So, two things there, right? It's what's the Fed going to do next week, and then the housing market reaction. 30-year fix has bounced between 6.5 and 6.75 this last week. I tweeted out a couple times on those 2 days out of the 5 days this week where it bounced down to 6.5. We'll see. Maybe it comes in at 6.5 today. We're recording before the first read on the 30-year fix comes out. But anytime it gets to 6.5 when it was just at 7, I'd be locking some people in for weekend shopping. Okay. If you're not having that conversation, hey, I know we're going out this weekend and I see our list is 8 homes right now. If you're thinking that one of these homes might be the one that we're going to go and make an offer, let's try to lock in now. Let's talk to the lender about locking in before we go out here this weekend so that you're at 6.5, because you and I, before the show, like, we've never seen rates change this much. It could be 7.1 on Monday. And so I want to get locked in if I'm a buyer. And then to your point, if I'm looking to put money anywhere in 2023, and this is going to be good for housing, I mean, geez, bonds, right? Oh. I mean, look what's happened with the banks putting money into bonds. You don't want to just leave your cash in the bank. That seems like a risk right now. I mean, where do you invest money? You saw what's going on with SVB. You know how risky it is investing into somebody else's business. I'd caution anybody investing into a business that you don't have control in. If you've got your own business right now, if you're a real estate professional, which you likely are listening to this pod, hit the thumbs up, by the way, if you are, then you should be doubling down on your business if you know it inside and out and you can make a margin on it. But other than that, real estate is where you want to put your money because it is something that is indestructible to technology and getting a return on your money. And Tom, I shared with you that Fortune article.
Yep.
Where, let me pull that up. I don't know if you can pull it up or anybody else can behind the paywall, but we'll link it down below if you don't have the paywall there. I'll break it down for everybody. Homeowners who held on to a 3% mortgage rate are becoming accidental landlords. Okay, so inflation is obviously real. You and I are both in the camp. Jerome Powell, stop.
Please, we're begging you.
Stop with the rate here. We know it's real, but you are going to destroy the economy just like we tried to do in 2020 when we stopped the economy. So inflation's real, but when you have an asset where debt is fixed, and especially if it's fixed at 3%, like all of these mortgages out there, and we're running at inflation above 3%, you win, meaning the person holding the 3% mortgage. It's like printing money. And the 30-year fixed rate debt, that's the magic in this. And so when people are like, okay, well, I've got 2 homes and they're both at 3% or less, I really don't need both of them. This is what they're talking about, becoming an accidental landlord. And this is what's holding up inventory because they're just going to keep it. So until we actually get that 30-year fix closer to 4.5, where it makes sense to hey, let me get that on the market and maybe move that money into something else because when we're talking 1.5%, if the 30-year fix is at 4.5 or 5, I can make that decision. But when it's closer to 7, I have a hard time getting out of my 3% asset. I'm killing it. Like Zuber here. Who is this Zuber guy? Quoted Michael Zuber, the offer of one rental at a time and former tech worker turned real estate investor, told Fortune, this 30-year fixed rate at 3% is the best asset to have in America today. And that's why people aren't selling them.
Well, and the fact that you bring that up, I mean, I've had some explorations with some CEOs at high-level mortgage companies about this. This is the jam up. Is there a portable option? Are there things you can do, which you can do in Canada? There's too many moving parts. It's just like the FHA assumable loans. Everyone thinks this is a great idea, but consumers can't understand how you can sell that rate with the loan, and a lot of people can't communicate it. And what ends up happening is you've got folks that are locked in. We've already seen the length of home ownership rise dramatically even before the pandemic. It used to be about 7 years. Now it's north of 11. So you're almost doubling that, right? It's almost up, not doubling. It's almost up 50%, right? So because of that, and with this rate hike environment that we're in, it's just not making sense. And our friends at Keeping Current Matters, they put a great chart there. I just sent this to Bobby to put up on the taping here.
Yeah, put this up.
That when you hit 6.5, the demand picks up. And we're in I think you got booted out of the group text, but we're in a group text with a lot of team leaders across the country. And when this SVB news hit, Byron didn't engage. He got voted off the island.
Don't put me on a 50-person group.
The max is 20.
Text message.
So you're already more than doubling the actual numbers here. That's not the point. The point is this.
If people want to wish happy birthday every other day in a group text message, yes, I will gladly opt out of the text message.
I don't even tell people when my birthday is because I don't care. So I think that's the move for guys like me and you. With that in mind,
likes me enough to wish me happy birthday.
I would wish you a happy birthday. I'd probably send you a video too if I knew when it was, but I also don't care. So there's that.
I will not disclose.
Yeah, see, we're in the same boat. This is why we're focused on this stuff here and helping people. So if you share your birthday,
this is why we need Lisa, because she would say right now, "Shut up, you two bitches," and get back to the subject at hand.
Yes, if you share your birthday, let us know in the comments. I'm curious about that. So anyway, this chart from Keeping Current Matters. It's when rates hit 6.5, the demand almost shifts instantly from weak to good, right? And we'll put this chart up there, and it showed what happened so far this year. And if you look at how the markets reacted, we saw that pump fake in January because rates were lower.
Yeah.
Then when they went up north of 6.5 at the beginning of February, I think that was a harder time. Or it was really mid-February, like the 10th or so was when they came in about above 6.5. And it's weakened buyer demand. And now we're starting to see it come back. The group text that we're in, or that I'm in, it's team leaders all across the country. There's such a demand for single-family homes that these banking failures aren't going to have an impact on it. That's what a lot of predictions are. They're worried about commercial real estate, smaller regional banks. The demand is still there. So if you get people at an affordable rate and that deal becomes really juicy for that person with a 3% rate, or maybe they have a low loan balance, so it doesn't really matter, they're cashing out anyway, that's where things get exciting. The challenge is a lot of homeowners, we have more equity than ever, but if your LTV is a little higher and you're going to go buy something else, you're trading for a higher monthly payment. So I don't blame the accidental landlord. I think it's a smart business decision, and we can't control the rates. That's why the Fed is kind of the issue here. And we go back to my source. There really is a little bit of a policy blunder that happened, and they got to slow down. What do you tell your agents, Byron? I want to talk about this. I think this is relevant here. When a deal's in progress, right? It's getting a little hairy. You don't know if it's going to move ahead, which has happened to all of us. Do you have them freak out and call everybody right away and micromanage it? Or do you let it play out a little bit and see how things go?
We're on the buy side or the
either
side
here? Either side. Do you let it play out and let the decision makers make decisions, meaning consumers, or do you have them micromanage it and call them every 5 minutes?
My style has often been it does depend on the deal, but my style has often been to let a few things play out, not avoid the situation. I want to be clear on this. When I say that, it doesn't mean you exit the conversation like I exited the 50-person group chat. It's you don't disappear for 2 or 3 days, but you don't get all strung up. This has been an issue with agents and why agents have had a bad stigma for a long time. They get wildly emotional in the transaction, and we're being paid to not be emotional. We're being paid to absorb the emotion of the person that is actually spending the money on the asset, and to be reasonable, and to be the fiduciary, and to be somebody who's able to orchestrate with confidence that they've seen the situation before and they have a solution for it. So I tend to say, you know what, that there's in a time of high anxiety and drama, there is a moment to take a step back and let some of the conversations play out, because when people take a breath, often the data becomes clearer. When you're highly strung up on anxiety and drama and fear, it's hard to see the data. It's hard to understand it in that situation.
I totally agree. And what knowledge brokers do is they don't avoid the situation. They don't run and hide. They play offense and they charge, right? They charge the issue. There's deadlines in place, right? There's time to let things play out. And I'm clear if the Fed took that strategy here and let this play out a little bit, because right now emotions are high. Right now, there's a lot of volatility. People are nervous. We got an objection from a seller over the weekend literally asking, hey, what does this bank collapse mean for me listing my home? Right? I mean, it happened that quick. This is like Saturday afternoon. And this is someone that's sophisticated, has a higher price listing, knows the markets, but this is people don't know. And if you let it play out a little bit instead of micromanaging this and adding to the drama, because Jerome Powell's speech last week before the show, there's a lot of drama there. Him and Elizabeth Warren yelling at each other. It's a lot of drama, right? I mean, you had a lot of notes on this. I saw you posting from Senator Warnock. I mean, there's drama there, right? He's getting questioned. He's getting asked tough questions. That's fine. A lot of drama. This is very akin. I don't know if I used that word right. This is very similar to a real estate transaction, because there's people involved. There's a lot of money at stake. And if there's too many movements going on, no one can get a real handle for what's happening. And I am clear that the Fed should take a page out of that book. Don't avoid it. Don't disappear. Just let it play out. Hey, we're going to give this 30 days. Let's see how the market reacts. No different than when you take a home to the market and you're unsure about the pricing. Maybe there's not comparable sales, right? Hey, let's give it a couple weeks and let's let this play out and see what the market says if we're unsure, Mr. or Mrs. Seller. I think this is the same conversation someone should be having with Jerome Powell. Unfortunately, I don't think that's going to happen.
Yeah, there's a balance with it, and this is where the best agents are going to earn the most income, because they're highly sophisticated in the way they negotiate. They're very experienced in those situations, because there is time does kill deals. If you disappear and just let time run on endlessly, like something's going to happen, that'll kill a deal. At the same time, if you're on the other end of the extreme, like we're talking about, and just like pounding on every single angle of the transaction, just being relentless with the lender and being relentless with the mom of the buyer, and you're getting everybody's emotions strung up, that can have the same negative impact. You also said something in there about this 6.5% mark on the 30-year, kind of
it's kind of the breaking point. It's where
being
people,
a breaking point.
Yeah, and I mean, I'm just taking the data for what it is. I can tell you, I mean, we've seen it, right? I mean, when look at October, when rates went up north of 7, the market pulled back dramatically. And February was a tough month. I mean, we talk about this 3 times a week, right? Where how's deal flow, and it's been interesting because the markets, Connecticut, Massachusetts, and here between our 3-person accountability call have been a little different, or maybe there's different dynamics happening with the conversations. That's tough to tell because it's so case study based. 6.5. I mean, if rates stay around here, I'm more optimistic for the second half of March, than I was before all this stuff happened in terms of sales activity and people wanting to transact, because the reality is the people that are out there now, I mean, they're going to have to move, and there's always deals to be done no matter how volatile the market is. So that could ease concerns a little bit. And that's what I'm hoping happens. And I'm hoping the Fed backs off. And at least we kind of have an idea they're using that 25 basis point increase as the benchmark.
I think there's like 3 levels to the way I'm thinking about the 30-year fixed, and it's at 7% or around 7%. To your point, October, we're going to see demand really go away. So that's not good, right? So 7%, you really see demand go away. Anything close to 6%, the pent up demand feels confident enough to enter the market. And just based off of the last year and looking at things and having this inventory discussion over and over and over again, I just believe that if we can get an interest rate at 5%, so 7% demand goes away, 6% we free up pent up buyer demand, 5% we'd free up inventory, which is what we need. Because moving from 3 to 5 isn't the end of the world. It's not, it's not like I want to go from 3% to 5%, but I refuse to go from 3% to 7%. So at 5, we start to free up inventory. And those are the 3 levels. And the closer we can get to 5 and the sooner we can get there, I believe the better chance we actually have at introducing new, fresh inventory into the market. And that's what we need for affordability now more than ever.
I mean, that's really well said. I mean, 5%, it's a benchmark for a lot of people. I know investors that we've worked with that want their benchmark for an investment is I want a 5% cash on cash return on my money I put into the property. And if it's less than that, I'm not going to look at it. If it's more, that's fine. 5% seems to be that number that people feel good about when they're investing. And people buy a home because they want to build wealth. I mean, there's obviously a lot of reasons to buy a home, tax benefits, all that. We're not going to go through that. Anyone listening should probably know those. And if you don't, get to work on it, because you're not the knowledge broker if you can't communicate that effectively.
Well, let's talk about some basic skills on how to work with investors, because I think it's going to be really relevant to the audience.
Sure.
But first, make sure you're making an investment in your business.
Yes.
Okay. If you want to be more productive here in 2023 and you want to focus on those income moving activities that Tom and I talk about every single day, you need a well-trained team behind you, right? You can either join a team or you can start to build around you and your business by hiring a virtual assistant today. A well-trained and versatile virtual assistant from VirtueDesk can help you leverage your skills to ensure that you're spending your time actually bringing the data to your client, being the knowledge broker, following up on the leads in your database. If you need an administrative virtual assistant, a marketing virtual assistant, a prospecting, inside sales, or customer service virtual assistant, VirtueDesk has you covered. Use the link below and the code BAM23 to save $250 off your startup cost, BAM23, with the code for the link below. That's VirtueDesk. I use VirtueDesk. And if you want to advance your business today, you should as well. Tom, for people who are working with investors, right? Because I think this is a clear opportunity, as investors have gone in some degree to the sidelines right now, but they're on the sidelines maybe on pulling the trigger on buying, but they're not on the sidelines of being actively looking in the market. And so those agents that don't have the stamina, oh, you're not buying in the next 6 months, they don't have the stamina to actually provide data or have conversations or do showings with these investors. These investors are not only shopping for a deal, but they're often shopping for an agent who's actually got the stamina and the knowledge to stick with them through this process. And then, maybe in quarter 3, quarter 4, they bang 3 or 4 deals. What's your advice to an agent right now who wants to get into the investment side, either themselves or more picking up clients, what they can do right now to add to their database on investors that can change their course of their business? I've seen what it's done to Nicole White. You're talking 10 to 20 transactions a year when you have the right couple investors in your corner.
Yeah, and investors, it can go a couple of different ways. So what it starts with is, what's your investment strategy? Because there's a lot of ways to go, Byron. There's long-term rental holds, right? I do that personally. I know a lot of people that do that. That's a different conversation than someone who wants to do a fix and flip. A little more difficult to execute, in my view, at least in our market. Do they want multifamily? Do they want single-family homes? Do they want single-family residences? So you've got to see what their strategy is, number one, and have a conversation with them about it and ask them what their criteria is. Because if someone's coming in, they don't know what to look for, it might be a harder push working with them as an actual investor client. So it's no different than a buyer consultation. It's the same process. You're asking different questions. Then let's say you're out showing properties, right? The questions you want to ask are, what's the income and what are the expenses, right? Pretty basic. And this is for rentals specifically. What are the income? What are the expenses? Are you factoring in things like property management, insurance costs, common utilities? What's your carrying cost on your mortgage every month if you're financing? Do they know that most investors need to put 25% down? Are they financing it with a commercial entity or in their own name? I'd recommend the latter because you're going to be protected. Are you working with a bank that can finance that? I mean, these are all things a lot of people don't know. They think they'll just put it in an LLC and get a 20% down conventional loan. That's not the case. So those are questions to ask there. I'd rewind this and take notes on that. That's going to be really helpful. Go ahead.
I'd also have a spreadsheet that I use to calculate an investment, whether it's a 4-unit, 3-unit, a small investment. I remember when I had a client. He was a first-time investor client, first time he was going to make this type of investment. He was looking at 4 units specifically. So I had an Excel sheet that walked through all those questions that you just discussed. Okay, if you put down 25%, if you put down 50%, what's going to be your return? If we have 10% vacancies each year, okay, what's your going to return look like then? Are you self-managing? Are we paying somebody? All those things you just said, right? And I walked him through my spreadsheet. Now, he had something on his own that he was looking at, but I opened his eyes up to a few other scenarios that might happen. His mother was sitting in on those meetings. His mother happened to be a mortgage lender. And she said to him, she goes, Ryan, this is the guy you're going to work with because he's got your best interest at heart here because he's focused on the numbers because this happens to be an investment. Your feeling about the property is less than 10% of the equation when we're talking about these investment deals. The numbers have got to work. And right now, today, if you're advising a first-time investor or somebody who's highly sophisticated, and say you're looking at single-family investments, in most markets, Tom, the only way the numbers are going to work is if you're paying cash, if you're Dave Ramseying it. If you're going out and pulling a mortgage on a single-family home, there's very few markets in America where you're actually going to be cash flow positive because of the interest rate.
Yeah, that's a really great point. And it's, to me, the numbers have to make sense. And if the numbers don't make sense, the biggest mistake, I'm going to buy based on appreciation, Byron. I'm just going to hope this asset value goes up. And it's a mistake a lot of people made during the Depression leading up to 2008. There was a lot of speculation going on. So you can't buy a property based on that. The numbers have to make sense, and you have to make money on your money, period. Like I said earlier, the bottom line for me is if I can get a 5% cash-on-cash return, meaning the down payment and the closing costs I put in the property based on my monthly cash flow with all expenses for the year, I'm good. Now, obviously, you want more, you want better, but 5% is my number. Some people may say I need 7%. They're going to have different criteria. That's just that's the conversation you have to have up front. If you don't understand like profit and loss or income and expense, it's how much is your monthly mortgage payment plus all the other costs. So utilities, insurance, taxes, any sort of property management fee. If they're saying they're not going to have a property manager, are you ready to take the 11 o'clock phone call on Saturday night when a pipe bursts and you're dealing with the house? That's the stuff you've got to be ready for. And your insurance is going to be a little higher because
insurance,
I mean,
trash removal, snow removal,
literally every single
expense
thing
has got to be calculated.
Landscaping, right? So, I mean, who's going to cut the grass? Right? All these things. So I love the spreadsheet idea. We have something similar in our team. A lot of investors, I find they get hung up in cap rates. And to me, like cap rate is, sure, it's a number. To me, it's what return are you getting on your money? And if you communicate that to them, you're going to perk up a lot of people's interest because that's what they really care about. Is this a money maker or a money loser?
There are very few agents in 2023 that have to worry about the cap rate. It's a commercial broker who is dealing with a 400-unit building in a particular market where the cap rate is even going to become part of the discussion. And even on those deals, the cap rate is a smaller part of the discussion than everything else. If you've got somebody telling you they need to know the cap rate on a threeplex, they don't know what the hell they're talking about.
I agree. We literally had a conversation with Brian Blauk, our sales manager, and he said, "Hey, if the investors don't know what they're talking about, you probably don't want to work with them." And the first-time investor to me is the toughest investor to work with because you're spending all this time educating, and they're relying on you. Which it's if you're ready for it, go for it. I'm not saying don't do that, but understand they're going to look to you as, hey, this was a loser, Byron. I don't know if I like this. So there's a little more pressure there with them. That's why that initial conversation about educating people, understanding things like how are you going to screen for tenants, who's collecting the rent, do you have a separate bank account set up, all these different things. It's so critical right now, and there will be investors that come back to the market the next couple of years, especially as the market continues to change a little bit.
Hey, I've got one more thing on the investor thing. The biggest opportunity for real estate agents in 2023 to work with investors is to just build the trust on, hey, if I find you deals, you're willing to spend how much? Oh, you got a $2 million budget? Cool. I'm going to go out there and find you off-market deals. And is it 14-day close? Is it 21-day close? Can you show me that you can perform? You're good? Because I'm going to go out there and actually find you opportunities. You do that for an investor, you might have just built yourself a client for life. It's the hustler agent right now that's willing to go out there and not wait for it. It's what you're talking about, but you've been talking about the last 3 weeks, Tom. It's running into the storm and showing them, I'm going to go out there and find you the opportunity. Yeah, show them your Bill. You're going to become a Buffalo Bill fan the more
never. No, would never happen.
You're a Bills fan now.
I'm not a Bills fan. It's not.
Are the Eagles losing have they been losing everybody here?
They re-signed. They're reloading, man. It's they're bringing back they got a lot of. Who cares about that? Let's go back to the regular subject.
They just brought in a backup quarterback who quit on his team last year. But
yeah, I saw that. A good thing they have Jalen Hurts, who will not quit on his team. So you have that guy.
All right, I've got a hard stop, unfortunately. Where do you want to end with?
Last thing we got to talk about.
Yeah,
we talked about inflation. We talked about inventory. There's a piece of positive news this week. I'm going to be positive Pete to end the show here, Byron, not the negative Nancy. So, what do you think?
Terrific Tom.
Terrific Tom. Tom's tops. Badass Byron. Bitchy Byron might be a better one.
There you go. That's what Lisa would say.
So here we go. The pace of single-family building permits rose 7.6 month over month in February. And to me, one of the best ways to battle inflation, which is the Fed's apparently only goal, I mean, that's all they talk about, is to bring more inventory to the market. So how do you feel about this news? I mean, I think this is part of a seasonal bump personally because you can't build a lot of homes in the winter, at least in the Northeast. Housing starts were up in February. Is this a sign of good news to come? Is this kind of clickbait? This was on Housing Wire. It got published yesterday. What do you think?
It's better than the alternative.
I agree.
But far too many of the new builds are priced above median price points in every single market because it's not their fault. It's so expensive to build. There's hurdles they have to jump through to be able to start a project. And so they've got to price it at a certain point. I'm not blaming the builders for the prices. It's the reality of where we're at with a bunch of different variables. It's not enough to move the needle for more people to get into home ownership. And until we actually see the interest rate, and listen, some of the builders can offer a lower interest rate.
They do.
So, that may free up that move up buyer a little bit to be able to jump into the new construction. We're 9-10 years backed up as it relates to, new housing inventory. So we want to see new housing starts be in the positive for like the next 5 to 10 years. So this is good. It's not going to impact 2023 all that much though.
Well, and you look at our markets, right? There's not as much new construction here as you see in Midwest, Southern, Western states. I mean, there's just a lack of places to build. So what I envision here is that we're going to see more, if there is more building, it's going to be pushed into more rural areas outside of metro marketplaces. So it's better. I agree with you. The biggest lever right now, if I had a wish, right, if I had a magic wand and I could wave the outcome of what happens next week at the Fed meeting, I'd love to see that 0, or in my case, 0 Tyrese Maxey for the interest rate increase.
Knows who that is? People actually know Robert Parrish.
I mean, maybe people your age, although I'm older than you. So
put some zeros in the comments if you'd like to see a pause next week for the Fed, and when we return to Knowledge Brokers with Lisa Chinati next week. I think she'll be here next week.
Let's hope so.
We will break it all down for you. Until then, go have yourself a great week. If you're listening to this over the weekend, consider sharing this with somebody who would like some more knowledge.